Hi, welcome. Today we're going to talk about Roth employer contributions for owner-only plans. This is our disclaimer. This presentation should be viewed as general in nature and is not intended to be substituted for legal or tax advice. Please do consult a qualified professional if you need legal or tax advice. So jumping right in, today our presentation will be focusing on owner-only defined contribution plans that NOVA is the third-party administrator. So again, plans with employees and maybe plans that may be with a record keeper. They are kind of subject to some different rules, and there's other different parameters. So today we're going to focus only on the owner-only plans. So we'll do a quick introduction, very quick, and a quick Roth review, and then we'll do more information about Roth employer contributions. So Secure 2.0, you may have heard about this, but there was sweeping changes to the retirement landscape passed in late 2022. A whole year passed by, and late 23, the IRS released a grab bag of guidance. And in this grab bag, it gave us additional information about how to implement some of the changes that were passed in 2022. So two of those have primary applications to owner-only plans. One is the Roth employer contributions that we're speaking about today, and another one is some possible tax credits. Now that one is covered in a separate recording, also available on our YouTube channel. To recap Roth in general, Roth in 401k plans has been around a number of years now. It allows benefits inside a 401k plan that are comparable to a Roth IRA. And except that with 401k, there's no income limit. So no one is excluded from making Roth 401k. If a plan has that available, then one can make it. One thing to note is it's not additional deferral amount on top of the pre-tax. It's kind of subject to the regular 401k limits. For example, for 2024, the limit was $23,000 for under age 50 and $30,500 for over age 50. So it would be a combination of pre-tax and Roth that make up that limit. With Roth, the contributions are made with after-tax dollars. So taxes are generally paid now and deposited into the plan as Roth contributions. Because they are not made pre-tax, they're made after tax, they are required to be record kept separately. And that is so that the correct taxation applies later down the road when it's taken out as a distribution. Roth 401k does allow for qualifying distributions, including the earnings, to come out tax-free. A qualifying distribution would be allowed when Roth has been in the plan for a 5-year period and the distributions made after 59 and a half death or disability. If those items are met, the distribution will be made tax-free. And here's just a quick graphic, between Roth and traditional. So Roth goes in after tax. So taxes are paid now on Roth money. They stay in your account, and then when you get ready to retire and take a distribution, if you've met that qualifying distribution, then they come out tax-free. In traditional or pre-tax plans, you don't pay any tax now. The money goes into the plan pre-tax, before tax, and then later on down the road in retirement, when you take a distribution, that's when you pay the taxes. So with this Secure 2.0 Roth employer contribution allowance, you are allowed to make an election to treat your employer contributions as Roth in your account. Now, when I say employer contributions, sometimes we call it profit sharing, sometimes we call it match, but it's basically the contribution that your employer is making on your behalf, or you're making on behalf of the company. So it's deductible to the company. These contributions, Roth employer contributions, would be made on an after-tax basis. So if an individual elected that, then it would be included in your gross income for the tax year in which it's allocated. So for example, if you're planning on making a employer contribution, then for the 2023 plan year, so you are making it for the 2023 plan year, depositing it now in 2024, the amount is taxable to you in 2024 and will be reported on a 1099-R that you'll receive in early 2025. So again, kind of the tax year and the plan year are a little bit different, but it will be taxable to you in the tax year in which it's deposited. When the money comes out, the distributions have the same treatment as Roth elective contributions. So in the plan for 5 years, earnings and contribution come out tax-free. Again, as we talked about in the last slide, this is not by plan year. So right now in 2024, you may be deciding to make your 2023 employer contribution. That would generally be deposited now in 2024, so it would be taxable in 2024 with a 1099-R issued in January of 2025. We do want to note you should consult with your CPA about your intent to do this, as it may affect your estimated tax payments, and you want to make sure they're aware of that. So if this is something you're interested in and you do want to designate your employer contribution as Roth, you can reach out to us and let Nova know. There will be a salary reduction form available and an employer election form available. Those will be emailed out to our clients, but they're also available upon request. You just want to make sure that you have in your file the salary reduction form where you elect that you want to do your employer contribution as Roth. Likewise, we will need an employer election form once the deposit's made so that Nova has the appropriate information to help generate your 1099-R. You can either complete those now, or we will be sending out correspondence in December of this year just to make sure we got everyone who is needing a 1099. So additionally on what to expect. The Roth employer will be included with the Secure 2.0 required amendment. So with these sweeping changes, the IRS will have a required amendment that will be due in 2026. This Roth employer contribution will be a part of that. Now, it isn't available today because the IRS hasn't improved the language. So, basically we will operate in good faith until the amendment is available and due. There is the fee for interim amendments that's generally listed in your engagement agreement. So that could be an additional fee or will be an additional fee when that time comes. If you do decide to do Roth employer contributions, you should note that there is a 1099 fee of $125 per transaction. And there could be an additional money source fee, so that's something you want to keep in mind as well. Nova charges for by money type for plans that we record keep, and that's $100 per money type. So for example, if you have pre-tax 401k money in your plan, that could be one source. If you have Roth 401k in your plan, that could be 2 sources. If you also have profit sharing, that could be 3 sources. And then this Roth employer contribution will need to be a totally separate source, so that will result in an additional $100 fee annually. And if you have any questions, please don't hesitate to reach out to us. You can contact our Solo K Services line or email us at solok@nova401k.com. Feel free to check out our website for additional webinars available, as well as our YouTube channel for recordings. Thanks so much for your time today. Have a great day.